let's just jump right into that. There's been a lot of data coming out this week. Let's start with the high points. What most surprised you that you saw this week?
Well, I think what really surprised me was when you look at the bulk of the news that the stock market actually weathered the storm fairly well. Small cap stocks are up 1.5% on the week. The S&P was up almost 1%, and the NASDAQ finished roughly flat.
So with that information, seeing the market kind of do that, but what was the data? I heard CPI, PPI, Danny talked about it in the open here, but there was a lot that came out this week. A lot of, I don't want to call it necessarily surprises, but just a lot of data in directions some were not necessarily expected.
Well, the headlines were very positive on CPI and PPI, but when you looked under the surface, the core CPI remains well above what the Fed is targeting. PPI was a good number as well. So the market, kind of rallied on that on Thursday, and we saw basically that the Fed fund futures continue to say the Fed's going to raise rates 25 basis points in May, so no real reaction from the fixed income markets. The number that really was a little bit worrisome was the retail sales number on Friday came in well below expectations, up 2.9% on a year-over-year basis, and that's in nominal terms. So if you adjust for inflation, retail sales in terms of units are actually down. And then when you compound that with the consumer sentiment survey, which on the surface sounded good, when you look in the finer details, what you saw is investor expectations about future inflation actually ticked up to 4.6% from 3.6%. And this is exactly what Chairman Powell does not want to see.
Yeah, and I agree with the inflation. I mean, I bought fertilizer. It was up $20 from last year, and sugar's more expensive. Well,
sugar's at a 10-year high, so that's not going to be great for Coca-Cola's margins going forward.
Well, and you also look at oil. I mean, you mentioned earlier when we were talking, oil's up $20 a barrel from last month to this month. I feel that at a pump, and I think everybody's feeling that at a pump.
I mean, the way I look at the current environment, I just got back from Sanibel Captiva in Florida, and they had a hurricane, and it did a lot of damage. So the first part of the hurricane that's hit the financial markets is a Fed tightening rates. That caused multiples to compress. I think we're now sort of in the eye of the storm because we're waiting to see what the effect of all those rate hikes will be. They raised the Fed funds rate 475 basis points in a very short period of time, and many investors got used to paying zero in terms of interest. So interest expenses for companies will go up. Valuation multiples ought to be compressed somewhat, and there's going to be a credit seize up at some point in the future.
So talking about that, you're talking about, the interest rates all. But then there's earnings that started this week. And Friday was the first day we saw this. JP Morgan came out. What else, what did we see from that?
Well, JP Morgan, that is a very, very well-run bank. Great operating metrics. They blew the cover out of the ball. The stock closed up 7% on the day. And investors are interested in JP Morgan because they wanted to see what the impact of those bank failures was. And yes, they did gain deposits from smaller banks. Their net interest margins, they actually guided them up a little bit. So JP Morgan put in a great number. PNC, Wells Fargo, those numbers were a little squishier. And next week, we're really going to hear from the banks we want to hear from. Those are the commercial real estate loaded regional banks.
So on that with the banks and the earnings, I know internally we've talked a little bit about opportunities, technology. Where do we see that right now with these rising rates? You've mentioned it before. Todd and Dave have mentioned rates and the impact on the tech sector and growth in general. What is that?
Well, the tech sector has been really strong at the beginning of the year, and these are companies that basically overhired during the pandemic. So they've been cutting costs, and investors have rewarded them with that. Like, for example, Meta's up an enormous amount year to date, as is Apple and some of the others. But basically, the valuations are a 35% premium to the S&P. So tech stocks right now, relative to the market, are more expensive than they were pre-COVID, and frankly, at the peak of the tech bubble.
And that's just very interesting to see, given everybody feels like the market's not in a good spot. But actually, you've talked about multiples, you've talked about earnings. We're actually at a pretty expensive market, right?
Well, we are. If you strip out the top 10 weightings in the S&P 500, we're trading at about 15 times earnings, which is reasonable. But when you add in those top 10 names, we're more closer to 19 times, and that is an expensive market.